Hi, this is Richard Vague with Tycos. The Federal Reserve has announced its first interest rate cut in more than 9 months, lowering the federal funds rate by 25 basis points. Although this move is relatively modest, it marks an important shift in monetary policy after a period of holding rates steady. But how big of a deal is this really? One thing to be sure to note is that any expense reduction is always matched by an income reduction. So if the government's expenses go down because interest rates are lower, someone's income also goes down by that exact amount. So the question now is which sectors win and which sectors lose. Overall, the impact is not as much as you might think given all the ink spilled on this subject, at least over the short run, since so many loans and securities have fixed rates. So all the excitement here for the economy is somewhat overblown unless this reduction leads to further cuts. Note that the process for determining the impact on the private sector from a change in rates is very inexact, since we can only estimate if and by how much a given bank reduced its rates on different types of loans to its borrowers. Here's our estimate of the rate cut impact over the next 12 months, what you might consider the cash flow impact to each sector. We do this without taking into account any impact of the rate cut on boosting stock prices, And there's just kind of the conventional view that if rates go down, stocks will go up. But even though the textbooks tell you that, when it comes to stocks, you never know. Let's start with the government. The federal government is projected to save around $19 billion in interest payments over the next year, while state and local governments will save another $4 billion. Not bad, right? But remember, much of Treasury debt has maturities well beyond a year, so the full effect won't be felt right away. If all government debt were repriced lower by a quarter point at the same time, the savings would be nearly $70 billion annually. Businesses will also see quite a large benefit since they are net borrowers, so they're net winners here too. As corporate bonds and long-term securities mature and as bank loans reprice, the gains from the reduction in interest payments will be significant. But over time, be aware that most of the benefit flows back to households, especially wealthier households, in the form of dividends and distributions, which our analysis takes into account. But if the government and businesses are winners here, somebody has to lose, and it turns out one of the biggest losers is the household sector, which owns most of these Treasury securities, either directly or indirectly. But wait, don't households have trillions in mortgages, and won't their mortgage payments go down? Not really, or at least over the short term, since most of their mortgages are locked in at long-term fixed rates. So as we look at households, we need to divide the analysis into the top 10% of incomes and the bottom 90% of incomes. The story for the bottom 90% of household is nuanced. They are only slight losers and will see only a very modest reduction in net interest income, about $440 million, or less than $5 per household over the next year. That's because they roughly hold as many short-term assets as short-term debts. Over a longer time frame, as those loans roll over or get refinanced, the full benefit could reach about $11.5 billion a year. However, the wealthiest 10% of households will see a large hit, about a $9 billion reduction in interest income over the next 12 months, growing to $51 billion as their assets mature and reset at lower yields. The other big loser is the rest of the world, which will see a decline in interest income of $13 billion. That reduction will grow to $30 billion over time as those securities mature and roll over. That's because they hold a lot of U.S. Treasury securities. They run a significant trade surplus with the U.S., resulting in an accumulation of U.S. dollars, which are mostly used to purchase U.S. Treasuries and other long-term U.S. debt, and their income on those securities will decline. Most financial institutions, including banks and investment funds, and frankly, including the Fed itself, will actively manage their balance sheets to smooth out the effect. So while there will be short-term winners and losers at the granular level among financial institutions like highly leveraged bond funds that have to scramble to adjust, at the aggregate level for financial institutions, these impacts tend to wash out fairly quickly. So, to sum up, the government and business will win, the wealthiest households and the rest of the world will lose. However, the benefit over the short term won't be as big as you and the stock market might think. That's it for this week. Thanks.